in terms of the rate decision itself, seemed pretty obvious.
Yeah, it was straightforward, and actually, I would just emphasise 8-1 in favour of a cut this time around. The first time they cut in August, it was 5-4. It was a split decision, and so you have actually more of a majority in favour of lowering interest rates the second time. That's despite the Bank of England saying we think inflation is going to be slightly above 2% through next year, factoring in the fiscal stimulus, and the guidance was look forward to gradual cuts. The question is, the Bank of England, like the Fed, keeps saying that monetary policy is tight, but he's not telling the market where it thinks neutral is on rates, and so we're trying to solve this problem.
I watched that yesterday. I was in the presser between the decision and Indeed, and I watched so many journalists trying to get him to say where our star was. And I was like, he's not going to say. There's no way. And Lombardelli, the deputy governor, she got involved as well, and it wasn't a ding dong, but they were like, no, we're not going to say, pretty much.
Well, let me see if I can say. 2% inflation plus normal economic growth is our best guess at the moment for neutral.
What's UK normal economic growth?
About 1.7.
Yeah.
No. Higher than that, much higher. About 1.7, 1.8%.
So 3.75 is the neutral rate.
That's the neutral rate. That's roughly what the market is telling you.
We've got 4 cuts coming to get to neutral.
Exactly, 1 per quarter next year. And the Bank of England can cut gradually into a healthy economic upswing, which has some fiscal support. And if you go 1 per quarter, you use the press conference meeting to cut. You then use the second meeting with no press conference just to say to markets what signs you're seeing in the economic data. And the monetary policy is kind of like religion. You see it from its works. You can't know from the interest rate whether monetary policy is tight or loose. And so as you gradually move rates down, you can see the signs from the economy. And then roughly by the end of next year, we'll get an idea that monetary policy is neutral.
But it doesn't work in isolation, of course. It works in conjunction with fiscal policy from the government as well. And again, I tried to draw out of Governor Bailey more about the response to the fiscal largesse of the Labour government as well, and indeed global fiscal largesse as well. I'm worried. No one else seems to be worried in central banker land about the implications for debt raising, for fiscal policy, on monetary policy going forward.
And I don't think they should be. The Labour government have some anti-growth measures in the budget, no question, but did a good job at preparing markets for borrowing, presumably spoke to the big dealers in markets to know that the issuance could be absorbed. The Bank of England was referring to that in the press conference yesterday, and so the market swallowed the debt. The
market swallowed it with a 60 basis point increase in yields across the curve pretty much as well. Yeah. And yet when I spoke to people behind the scenes there, they were saying, well, look at the OIS rates as well, look at the overnight swaps. Actually, it was very well taken.
Exactly.
But if we see the same kind of activism from short bond traders that we've seen at previous episodes in the United Kingdom and how the US bond shorts have tried to do, if we saw that magnitude again in the UK, we're going to go way beyond what those primary dealers and people can contain, aren't we?
We need to be careful. If it delivers more growth than inflation, the market can stay relaxed. If you look at the 10-year rate, it seems to be finding bids at around 4.5%, which I think is probably fine, not far off fair value. That's within the 2-year range. But sterling is close to a 2-year high. We're at almost 130 against the dollar. We were 107 during the trust budget. And so you have to understand the UK's bond market in context of currency moves. If I see sterling strong and bond yields rising, that's a signal that market is betting on growth, not inflation. Whereas with trust, it was a bet on inflation, not growth, and money moved out.